To this point, most of our focus has been on the left side of the balance sheet, or the company's assets. Earlier, I mentioned that the left side of the balance sheet is what you own and the right side is how you paid for it. In order to pay for things, the business needs to raise money. Most established businesses generate enough cash flow from their operations that they don't normally need external funding. Some companies do, though, especially companies with immature product portfolios, or those in financial distress, or startups that have not yet had an IPO. For companies that need external financing, there are two main ways to get it. Firms can borrow money, or they can sell an ownership stake to equity investors. In this video, we focus on some of the ways the different firms can borrow money. Borrowed money is a liability. A liability is a future claim from an outside entity on the assets or the future profits of the firm. Some liabilities are simple loans based on a contractual agreement between the lender and the borrower. Other liabilities are debts the company has with its suppliers or employees or even tax authority. Prepayments that others have given the company that have not yet been earned are another type of liability. In all of these cases, the company borrows money from someone who does not get an ownership stake in the business. One big difference between assets and liabilities is that assets were increased through debit transactions, but liabilities are increased via credit transactions. One similarity with assets is that liabilities can also be divided into those that are current and long-term. We organize liabilities by when they are due. Current liabilities include all items that are due to be paid within the next year. This includes unpaid accounts we have for our purchases, wages, or tax bills. It also includes any accrued expenses that we've recognized. For example, if we know we typically pay $250 per month for our electricity bill, at the end of the month, if we haven't received the bill yet, we need to set up an accrual for $250. We would credit the accrued expense account and debit the expense itself. That accrual process will recognize the expense and set up a reserve so that when the bill arrives, we can pay it. We then credit cash and debit the accrued expense to remove it from the books. Now the correct expense will hit the correct account in the correct period. Long-term liabilities generally refer to long-term debt or capital leases that you're recognizing as a liability. Long-term debt is normally a contractual obligation between your firm and the lender, which could be a bank, another company, or other investors, which could even include your existing shareholders. Just to clarify, though, the shareholders are owners because they bought stock in your company, and their ownership stake does not increase because they lend you money. Their loan would be another liability and unrelated to the equity position that they already hold. One type of long-term loan is a bond. A bond is a contract where the lender receives structured interest payments, also known as coupons. At the end of the bond's life, the face value is due then to the lender. The face value is the amount that is borrowed, and it normally happens in $1,000 increments. The bonds get recorded on the balance sheet at face value. That just means that we record the amount to be paid back when the company matures as the amount of the liability. The liability section of the balance sheet provides investors with a quick look at how much money the company owes to other parties. It's very useful to understand just how much risk the company is under. More debt means more risk.